Hey, what's up everyone? This is Silver Slayer. Thank you for tuning into this video. Silver prices are up today. I have some very interesting articles and a video I want you guys to check out. It's talking about the gold to silver ratio dropping 20 to 1, meaning it takes 20 ounces of silver to equal 1 ounce of gold, and how the next bull market will shock the markets. So interesting stuff. I also have GDX and silver relative weakness hinting gold may need a rest. Is gold overpricing right now? Is it becoming more of a standout metal compared to silver, and what would that entail for precious metals across the board? Interesting stuff in here as well. So first I want to go over, we have silver at $18.21, up 2%, up 2% on the day, up 36 cents. We also have gold sitting at $1,574, up 0.65%, up $10.12. So you can see the patterns between those two right here, very similar, but gold obviously goes higher, has been more bullish lately. But when is the gold to silver ratio going to become more normalized or down to more equal, fair levels? We see it come out of the ground roughly 8 to 1, but we see the ratios at 88 to 1, extremely high. I know I've said before on this channel, in the 30s, FDR changed the gold to silver ratio from 16 to 1 to 75 to 1, which drastically manipulated silver's price or undervalued it to a very large portion, which it's never really caught up to. It's been close to that in the 80s, when silver was $50, like in 2011, but it's never really corrected back down. So anyways, I'm going to read this short article. I'm going to read this article first, and you guys, the link will be in the description if you guys want to check out this video where it's going over it, but it's mainly summarizing it, just talking about the gold to silver ratio has never stayed in this high for this long, and it's only a matter of time before prices normalize, which I was mentioning. And this, according to Jeff Clark, senior precious metal analyst of goldsilver.com, says, I believe that the gold to silver ratio is probably going to fall to 20 to 1, which means that it would be extremely low, maybe even below that in the next bull run, because there's going to be such a shock that people are rushing into silver, he said. The gold and silver markets are small enough that any significant inflow of capital could push prices higher, Clark told Kitco News on the sidelines. So the gold market is so small that Warren Buffett could take less than 5% of his cash and buy every registered ounce of gold on the COMEX. It doesn't take much demand to drive the price higher. It doesn't take much demand to crimp supply, he says. If you believe we're going to have a silver and gold bull market, you want to make sure you're buying now before any of those kinds of things happen, which is really important to think about, because a lot of people rush into the markets after the markets have already started to correct or already have rallied. You want to get it early. You want to get in early, buy low, sell high. Get in right now while it's still low, and then reap the rewards, reap the benefits after it's already appreciated. Most people get in when it's already going to be $23. I was reading another article and it's talking about wow, everyone's going to be wishing that they bought silver now when it hits $23, when everyone's going to capitalize. And it's interesting to think about how that's 9 times out of 10, that's how it works. People like you and I that watch these videos and do research and understand how these markets move, we usually can get in earlier. I always say the producers turn into the consumers and the consumers turn into the producers, but the everyday person, the people that are in stocks that move in, that are very wishy-washy, that go in and out of these markets, they're the ones having to pay the price. But anyways, link to this article will be in the description as well. Let's jump into it. Although the rapid spread, along with equally rapid international response to the coronavirus from its epicenter in China, has left markets on edge, weakness continues to be bought in equities. The price of gold has also responded to the upside and remains well bid above the multi-year support at the $1,550 level. So, however, with the global developments so far this year sending safe haven capital into gold, traders have been mostly ignoring the miners. And that's something I've been talking very strictly about and very focused a lot upon, because that's demand, that's surplus, that's extremely important. The GDX GLD ratio began to trend lower as the year began, and the silver price peaked below $19 a few days later. Historically, both the miners and silver lagging to an extended move in bullion has meant a pullback, and it's expected to be soon. Gold prices have spent the last 2 weeks consolidating in the mid-1500s following the early January spike in the U.S.-Iran military skirmishes. While the miners have moved lower, any signs that the coronavirus is contained could serve as a near-term headwind for gold, though the medium-term uptrend remains intact as the yellow metal can hold above $1,535. So we see some support lines being thrown out there as well. Bullion edged higher but continued to move sideways on Thursday, while in the process of forming a near 7-year cup and handle continuation pattern. Although this is generally a very bullish technical situation, both miners and silver are not confirming this pattern may be resulted as an upside breakout. Moreover, it remains a cause for concern for the gold price to see the latest commitments of the traders in the COT report continuing to show extremely high commercial short and large speculator long positions. With the gold hedgers positioning at its most extreme bullish position in history, the futures markets is warning a moderation taking place before we see significant further gains. Meanwhile, the European Central Bank, the ECB, expectedly kept its ultra-loose monetary policy unchanged on Thursday. In addition to keeping rates unchanged, the ECB will examine whether it should alter its 200 billion corporate bond holdings to take account of the climate change. The newly appointed head of central bank, Christine Lagarde, promised she would launch its first strategic review in 16 years. So with the Federal Reserve being the last and largest central bank to hold its first policy meeting of the year next week, the continued rise in equities could force the Fed to once again turn to its domestic policy objectives. U.S. policymakers have already ceased to assist Europe with further interest rate cuts, as mentioned from the last weeks in the column. Kansas City's Federal Reserve President Esther George stated the central bank may need to revise these three cuts implemented in 2019 that brought the rates down to 1.5% to 1.75%. So the U.S. dollar cash settle index has been rising in the last few sessions following the December decline, which puts the greenback at a crucial technical juncture heading into the Fed week. A rising world's reserve currency would have negative effects on commodities, gold, and the relative performance of the international equities of the U.S., whereas a falling dollar would represent a bullish factor for gold and commodities. So, interesting to think about. The dollar index is something that's, I just want to make a side point. The dollar index is something that's really interesting. How a couple months ago we saw it moving up with gold and silver, which never happens. So that could have been an indicator that things can move. It doesn't have to be so polar opposite from each other. It doesn't have to be when the dollar index is high, gold and silver have to be low. Sometimes they can work together. Regarding of what's also side pointing happening in that point in time, whether it's stock market volatility, stock market setting record-breaking highs, the U.S., Iran, the coronavirus, there's so many different things, but it was a first, and I'm curious to see if that pattern starts to happen more and more in the future. Anyways, I'm just curious. That's a side point I want to throw out there. So with the CME Fed Watch tool pricing its underwhelming 13% chance of a rate hike, the central bank is widely expected to keep rates on hold. However, computer-based algorithm trades will be set to sell gold if the Fed becomes the slightest bit hawkish on the future monetary policy moves. This could very well be the reasoning for the miners lagging gold's move higher in the FOMC meeting speech the Fed chair told Jerome Powell next Wednesday. Therefore, caution is advised in the precious metal complex until the market has digested the remarks made by Mr. Powell on January 29th. So, do you think miners have enough push and pull in this market to influence prices? We know that supply and demand can be one of the most fundamental things that push prices higher, but we also see large silver shortages across the board. We see Mexico, Peru, Chile, Australia, China, some of the biggest producers of precious metals, more specifically silver, have been abandoning silver mines. I mean, literally, silver mines have been abandoned, and there's few focal silver miners that are actually digging it out the ground because it's not as profitable. So that's something to think about. But I definitely think we have insight seeing that industries, the industrial side of it, are paying premiums on silver bullion, which is never seen before. So people know the extent of this and what the consequences are playing out, and we're starting to finally see that. So anyways, my goal for the past few years has been to carefully construct a concentrated portfolio of exceptional junior resource stocks in the context of an investment time horizon at least as long as one cycle, which I feel has just begun. If you require assistance in choosing the best quality juniors to invest, please stop by the website. So, I've made lists I talked about stocks, mining stocks, all that stuff. And, I've given my point on it in the past several videos. And it can be beneficial, but that's not the point of this video. It's talking about, all of this together. And I definitely think that silver has to start outperforming gold, just like the article previously where it was talking about the ratio can go down to as low as 20 to 1. I definitely think that needs to happen sooner than later. For the ratio to be 16 to 1, silver only has to be $90 if gold stays the same price as it is now. That's something that's extremely low. So even if we do see $30, $40, $50 silver like we've seen in the past 30 years twice, that would bring the ratio down drastically, which could easily correct things and get the ball rolling in silver's court. So anyways, I hope you guys enjoyed this video. I'm curious what you guys think about this. If you enjoyed it, make sure to smash the like button. Make sure you subscribe for new because I do post daily videos. Thanks for tuning in. This was Silver Slayer. I'm out. Peace.